Mr. Baer, you are now recognized for 5 minutes for your oral remarks.
Chairman Baer, Ranking Member Foster, members of the committee, thanks for the invitation today. Congressional attention here is important given the stakes for the U.S. economy. It is further warranted because the agency's proposal would constitute a de facto repeal of regulatory tailoring legislation that Congress passed on a bipartisan basis in 2018. Before getting to the details of the proposal, I'd like to dispel 3 misunderstandings that have arisen around it. First, some have suggested that it is a response to the failure of Silicon Valley Bank and a few others in March 2023. Those banks failed for 2 reasons: interest rate risk and liquidity risk. The proposed Basel rule has nothing to do with liquidity risk or interest rate risk. It is about everything else: credit risk, market risk, operational risk, counterparty credit risk, and risk on derivative instruments. It is apples and oranges, or apples and refrigerators. Second, some have suggested that this proposal is needed because bank capital models understated risk and caused the global financial crisis. In undisputed fact, no U.S. bank had adopted the internal models approach to capital assessment by 2008. The global financial crisis occurred on the watch of a Basel standardized approach. Remarkably, a standardized approach that this proposal will continue. Third, some believe that while significantly higher capital charges will push activity out of the banking system, there's no problem with that, as non-banks will pick up the slack. There are a lot of problems with that. Banks lend and intermediate at lower rates than non-banks, not because they are kinder or dumber, but rather because their deposit base gives them a lower cost and more stable source of funding. As a result, banks are the only reliable lenders during an economic downturn. I remember asking a fintech executive in March 2020 how her firm had weathered the crisis. Her answer was, it was easy, we just stopped lending. Consistent with that, very recent research from the Bank for International Settlements found that non-financial firms cut lending by about 50% more than banks in the face of financial shocks. Turning to the proposal. The second half of the proposal is a series of formulas setting a risk weight for every bank loan or exposure, and the first half is a description of those formulas. What the proposal is oddly lacking is any explanation for how those risk weights were in fact derived. The proposal contains almost no analysis of the absolute or relative risk of the underlying assets or exposures. The absence of detailed historical analysis is incredible, given that the agencies possess a massive database of historical experience and have easy access to market data. In place of analysis, the agencies simply set the 2017 agreement negotiated by agency staff in Basel as a minimum requirement for U.S. banks. But that agreement is not a treaty, and it carries no legal weight in this country. Furthermore, it was adopted before the Federal Reserve began to impose a stress capital charge for many of the very same risks contained in the Basel Agreement. Most importantly, though, the proposal ignores reality. Since 2010, the nation's largest banks have weathered very large macroeconomic shocks and market turmoil, benefiting from diversification across both product and geographic lines. In contrast, the proposed rule implicitly finds that every large bank in this country is undercapitalized and requires on average 16% more capital. The proposed rule is calibrated at such a high level that it will be difficult to offer products that the Basel formulas and the Fed stress testers disfavor. Thus, and to an unprecedented extent in the history of this country, the decision of whether you get that loan and how it will be priced would be shifted from banks and their loan officers to the formula writers in Basel and the stress testers at the Federal Reserve. Lastly, I should note that while the agencies frequently refer to this as implementation of the Basel Agreement, the clear understanding at the time the Basel Agreement was announced in 2017 was that it would not increase capital for the covered banks and would probably decrease capital. This is completely inconsistent with that understanding. If the proposed rule were adopted, banks operating in the United States would be the only major banks in the world being assessed solely based on a standardized approach, would be the only banks in the world experiencing an explicit stress capital charge on top of that standardized charge, and would be the only banks in the world facing a variety of capital add-ons above the Basel agreed risk rates. And we don't know why. For any banks, and particularly for the regional banks, Congress specifically said should be exempt from this kind of treatment. Thank you for your time.